There's a pattern unfolding in 2025 that almost no one understands. A pattern that has destroyed every major market in history. A pattern that always ends the same way. The elites exit first. You absorb the impact. Right now, as you watch this, the foundations of the global financial system are shifting under your feet. Debt markets cracking. Liquidity evaporating. Insiders quietly selling into strength while the public is told everything is fine. But there is a secret buried inside every major collapse. From 1929 to the dot-com implosion, from 2008 to the crypto wipeouts of the last few years. The system is designed so the powerful can escape, while everyone else is locked inside the burning building. What's happening in 2025 isn't new. It is the continuation of a centuries-old blueprint, a blueprint that allowed kings, empires, banks, and billion-dollar institutions to offload their losses onto the public right before the collapse. And the terrifying part? It always looks stable right before it breaks. A bubble never pops when people expect it. A currency never collapses when the data looks obvious. An empire never admits it is falling, not even in the final days. Because collapse always follows the same paradox. The moment the insiders know it's over is the same moment the public is told to buy more. Today's $50 billion institutional exits, the sudden insider liquidations, the quiet sell-offs masked as rebalancing. These are not random. They are signals, the same signals that appeared before every historical crash. There's a pattern here, a mathematical structure behind the chaos. A sequence so consistent that historians can map it across centuries of economic rise and decline. And once you see this pattern, once you understand how the system truly works, you can no longer pretend the crash is unexpected. Because the truth is this: you're not watching a system break. You're watching a system operate exactly as designed. In the next few minutes, I'll show you the exact mechanism elites use to exit markets before the fall, how the pattern repeats with surgical precision, and why 2025 is not the beginning of the crisis. We are already inside it. What you are about to hear is not fear. It is not speculation. It is not conspiracy. It is documented history. Repeated, mechanized, predictable. And now, it's happening again. The 5-part insider exit pattern. There is a structure behind every major financial collapse, a hidden, mechanical sequence that determines who escapes and who absorbs the impact. Across 500 years of documented history, the same 5 stages appear. Empires change, currencies change, technology changes, but the exit pattern never changes. This is the blueprint. Stage 1. Artificial stability. A period where markets look calm, strong, and invincible. Governments suppress volatility. Central banks inject liquidity. Institutions publicly project confidence. Balance sheets appear healthy, even when they're quietly deteriorating beneath the surface. This is the calm before every storm. In this stage, insiders accumulate information long before the public. They see the leverage building. They see the debt spiral accelerating. They see liquidity thinning like oxygen at high altitude. To the public, everything feels normal. To the insiders, warning lights are already flashing. This is where 2025 began. Stage 2, the silent rotation. The most important stage, the one almost no one sees. Insiders do not announce their exit. They rotate. They rotate from high-risk to low-risk assets, from equity to cash, from overvalued tech to defensive positions, from public markets to private deals, from transparency to opacity. The rotation is always disguised as portfolio rebalancing or risk management. In reality, it is the first exit. The escape hatch opens, but only for those close enough to know it exists. This is always where the $50 billion exits begin. Stage 3, the information gap. The most powerful stage of the pattern. Insiders act on data weeks, months, sometimes years before the public even hears the first warning. They see declining earnings before anyone else. They see liquidity withdrawal before it hits headlines. They see the credit market drying up before the public even knows a crisis is possible. The information gap is not illegal. It is structural. The system is built so those at the top receive the impact data first, and the exit window second, while everyone else only receives the headlines after the collapse has already begun. By the time the news breaks, the rotation is complete. This stage is happening right now. Stage 4, the controlled sell-off. This is the decisive moment. Insiders sell, but markets do not fall. Why? Because they sell into public optimism. They sell into pension funds buying the dip. They sell into retail euphoria. They sell into central bank reassurance. They sell while the public believes the narrative. There is no crisis. This is just volatility. This is where liquidity disappears silently. The system lets them offload trillions without triggering panic. Every empire, every market, every superpower has allowed this moment to happen. Because without it, confidence collapses immediately. This is the stage most people never see until it's too late. Stage 5, the sudden collapse. The final and most violent phase. One trigger, just one crack, and the illusion shatters. A bond auction fails. A bank defaults. A geopolitical shock hits. A credit event cascades through the system. And suddenly, the same markets that looked stable implode. The same assets that felt safe evaporate. The same institutions that projected confidence lock the doors. This is where the public is left holding the crash. Because the insiders? They completed their exit months earlier. This 5-part structure is not speculation. It is the documented operating system of global finance. From the South Sea bubble to the 1929 crash. From a 1970s inflation spiral to 2008. From the crypto rug pulls to the tech wipeouts of the early 2020s. Stage by stage, the sequence is identical. This isn't prophecy. This is pattern recognition. And now that you understand the mechanism, it's time to see how this pattern played out across history with surgical, brutal consistency. How the pattern repeats with mechanical precision. History does not repeat by accident. It repeats because those who control capital, credit, and information behave the same way across every century. Empires change. Names change. Assets change. But incentives never change. And that is why the same exit pattern appears again and again. Let's trace it through documented history, step by step. Case Study 1. The Spanish Empire, 1500s, 1600s. The rise. In the 1500s, Spain became the richest empire on earth. Gold and silver poured in from the New World. Wealth exploded. Spain controlled oceans, trade routes, and the flow of global capital. To the world, Spain looked invincible. The structural flaw. But underneath the surface, something deadly was forming. Spain wasn't producing wealth, it was importing it. The empire inflated its money supply without increasing productive capacity. Prices soared. Debt mounted. The currency weakened. This was the first stage of the pattern. Artificial stability built on illusion. The trigger. By the early 1600s, insiders, nobles and financiers began quietly converting their wealth into foreign currency and foreign assets. This was the silent rotation. They exited long before the collapse. The collapse. Spain defaulted 4 times in a single century. The currency imploded. The empire fractured. The public suffered a century-long depression while elites protected themselves. The aftermath. The world saw Spain fall overnight, but insiders had been escaping for decades. The pattern had already completed. The public only noticed at the end. Case Study 2. The British Empire, 1900 to 1950. The rise. By 1900, Britain was the global superpower. Reserve currency. Industrial dominance. Unmatched naval control. The world believed the British economic engine would never fade. The structural flaw. But beneath the surface, Britain was overextended. The empire relied on cheap credit, global extraction, and the illusion of infinite stability. Debt ballooned. Real productivity stagnated. The trigger. As World War I approached, insiders began shifting capital to the United States. Quietly, strategically, exactly as the pattern predicts. By 1920, the City of London was already transferring gold to American banks, but the public was told Britain was still the center of global finance. The collapse. Two world wars shattered the illusion. The pound lost its reserve currency status. Inflation surged. The British Empire entered rapid decline. The aftermath. Insiders had already rotated into U.S. dollars, U.S. equities, and American real estate. The public held the collapse. The elites held the exit. Case Study 3. The 1929 U.S. stock market crash. The rise. The Roaring '20s created the illusion of endless prosperity. Speculation skyrocketed. Credit exploded. Consumer confidence soared. Wall Street projected stability. The structural flaw. Margin loans reached 12% of GDP. Banks were over-leveraged. Insider data showed slowing earnings and declining industrial output. Stage 1 was complete. The trigger. In early 1929, insiders began quietly liquidating positions while publicly projecting optimism. J.P. Morgan partners sold their holdings. Major industrialists converted stock into cash. The public never saw it. The collapse. October 24, 1929. The illusion shattered. The market fell 25% in 2 days. Banks failed. Depositors lost everything. The aftermath. Insiders sat in cash and gold. The public held worthless paper. The pattern repeated with brutal clarity. Case Study 4. The 2008 Global Financial Crisis. The rise. From 2000 to 2007, U.S. housing became the illusion of infinite wealth. Credit was cheap. Banks were expanding. Wall Street insisted defaults were impossible. The system looked invincible. The structural flaw. Subprime mortgages. Synthetic CDOs. Leverage exceeding 30:1. Hidden losses buried inside complex financial instruments. A collapse guaranteed. Only the timing was uncertain. The trigger. Insiders exited first. Goldman Sachs shifted from long to aggressively short mortgage exposure. Big banks dumped toxic assets onto pension funds. Ratings agencies delayed downgrades. The public didn't know the collapse had already begun. The collapse. Lehman fell. AIG nearly toppled the global system. Credit markets froze. Trillions evaporated. The aftermath. Once again, insiders were liquid before the crash. The public absorbed the damage. The pattern had executed flawlessly. Case Study 5. The crypto implosions of the early 2020s. The rise. The industry boomed with promises of decentralization, new wealth, and infinite upside. The structural flaw. No liquidity backstops. No reserve assets. Leverage spirals. Synthetic tokens printed from thin air. The trigger. Founders and insiders quietly sold billions, months before the crashes. FTX, Luna, Celsius, Voyager. Every single collapse followed the same script. The collapse. Tokens went to zero. Platforms froze withdrawals. Billions vanished. The aftermath. Retail investors held the losses. The insiders walked away long before the implosion. Centuries apart. Different empires. Different currencies. Different markets. But the pattern never changed. Artificial stability. Silent rotation. Information gap. Controlled sell-off. Sudden collapse. Documented. Repeated. Inevitable. And now the most important truth. We are not approaching this pattern in 2025. We're deep inside it. We are not heading toward the pattern. We are inside it. History is not a story about the past. It is a blueprint for the present. Every stage of the $50 billion exit pattern is already visible in 2025. And the truth is chilling. Stage 1. Artificial stability in 2025. The global economy looks calm. Markets hover near record highs. Central banks project confidence. Government debt appears sustainable. But beneath the surface, U.S. federal debt exceeds $45 trillion. Global debt surpasses $300 trillion. Corporate leverage is at historic peaks. Inflation-adjusted productivity growth is slowing. It's the same illusion Spain and Britain used to hide structural rot. Markets appear stable, but the oxygen of liquidity is thinning. Stage 2, the silent rotation. Insiders are quietly moving assets out of risk. Hedge funds have reduced exposure to tech equities. Billion-dollar institutional funds are moving into cash, T-bills, and gold. Cryptocurrency whales have quietly sold massive positions over the last 12 to 24 months. Venture capital is staging a rotation towards safer, private assets. The public sees optimism, earnings guidance, and Fed reassurance. The insiders see the cracks widening and are already exiting. Stage 3, the information gap. The information gap has never been wider. Big banks have internal data showing corporate defaults and credit stress before the public ever sees it. Hedge funds analyze liquidity mismatches in derivatives markets invisible to retail. Private institutions forecast debt spirals that mainstream media cannot report on. This gap allows elites to sell first, while everyone else buys late. It is not conspiracy. It is systemic design. Stage 4, controlled sell-off. Already happening. Subtle, disguised, yet deadly. Insider sales disguised as portfolio rebalancing. ETFs and passive funds masking mass liquidations. Central bank messaging smoothing the narrative while liquidity drains quietly. Major funds selling to retail optimism during minor dips. The public remains confident. The illusion of stability is maintained. Stage 5, the first cracks of sudden collapse. And the cracks are appearing. Credit spreads are widening. Treasury yields are volatile. Emerging market currencies are under pressure. Bank stress tests reveal hidden fragility. Geopolitical flashpoints threaten supply, chains, and energy security. One domino, one event could trigger the final stage. And when it falls, the collapse will appear sudden. But insiders will have long since exited. The pattern is not approaching. It is here. The $50 billion exits, the rotations, the liquidity drains. These are the signs. We are living in stage 3 to 4 right now. The warning is clear. History is not repeating. It is rhyming. And the rhyme is extremely precise. Next, we'll confront the inevitable. What happens if nothing changes? The doom sequence. The moment when the public is left holding the crash. This is what stage 6 looks like. Every collapse follows the same brutal mechanics. Once the $50 billion exits, the controlled sell-offs, and the information gaps reach critical mass, the system enters the point of no return. History shows it. Spain, Britain, 1929, 2008. Crypto wipeouts. And 2025 will be no different if nothing changes. Systemic failure. Banks that were too big to fail start showing cracks. Liquidity dries up overnight. Counterparties fail. Derivatives unwind with mechanical precision. Insurance companies, pension funds, and hedge funds simultaneously find their assets worthless. Markets seize. Transactions stop. Credit evaporates. This is stage 6, the engine of global finance grinding to a halt. Currency or debt crisis. Reserve currencies weaken. Debt becomes unsustainable. The US dollar could lose purchasing power rapidly. Emerging market debt defaults cascade. Eurozone and yen face liquidity shocks. Hyperdebts unravel. Countries struggle to pay for imports, interest, and obligations. Inflation surges. Savings evaporate. The public holds collapsing currencies. The elites hold hard assets, gold, and cash. Social breakdown. Economic pain manifests socially. Food and energy prices spike. Job losses soar. Unrest, protests, and political instability accelerate. The social contract phrase. Trust in institutions collapses. Governments scramble to maintain control, often with emergency measures, sometimes too late. History repeats. Spain's population suffered famine. Britain faced post-war austerity. 2008's public lost homes and retirement savings. The pattern always includes social fallout. Market collapse. Equities, commodities, and alternative assets plunge. Markets that seemed stable a month ago implode in days. Housing markets collapse. Stock markets freefall. Bond markets seize. Crypto and leveraged instruments vaporize. Retail investors are trapped. Pension funds are trapped. The public is trapped. The insiders? Already gone. Loss of global power/reserve currency. When the largest economy falters, global dynamics shift. Reserve currencies lose status. Trade flows reroute. New financial centers emerge. Geopolitical influence erodes. The empire, the nation, the system loses its dominance. And the world witnesses. The collapse isn't just financial. It is structural, societal, and geopolitical. This is the point of no return. Every past superpower, every empire, every major market crash culminates here. And 2025 is poised to follow the exact same blueprint. But here is the most crucial truth. Collapse is inevitable if you remain blind to the pattern. But awareness changes everything. Next, we'll move to the solution, where understanding the pattern gives you the edge to survive and position yourself strategically. 3 moves to survive the $50 billion exit pattern. Understanding the collapse is one thing. Surviving it is another. This is where the pattern becomes your edge. The elites already know it. Now you can too. The solution is not guaranteed. It is strategy. It is preparation. It is positioning yourself to survive, even thrive, while the collapse unfolds. Move 1. Liquidity and cash equivalents. The first step is immediate liquid safety. U.S. Treasury bills, short-term government bonds, cash reserves in stable currencies. These are the assets that allow you to exit positions at will, react to sudden shocks, and avoid being trapped in frozen markets. Insiders always move liquidity first. You must do the same, not for profit, but for survival. Move 2. Hard assets and gold. The second move is tangible, productive, or hard assets. Gold and silver as a hedge against currency debasement. Real estate or farmland in politically and economically stable regions. Productive assets that generate cash flow. When currencies collapse, paper wealth evaporates. But tangible assets retain value, often appreciating during crises. This is how empires preserved wealth across centuries, from Spanish nobles to 2008 hedge funds. Move 3. Geographic and asset diversification. The third move is spreading risk globally and across asset types. Do not concentrate in one country, one currency, or one sector. Consider foreign accounts, dual residency, or geographically distributed holdings. Diversify between equities, bonds, commodities, and productive investments. The collapse is systemic, but its impact is uneven. Where the public suffers, well-positioned actors have alternatives. 3 moves. That's it. Liquidity, hard assets, diversification, no complexity, no gimmicks, no chasing the next trend. Just the same type of strategy the insiders have used for centuries. The same strategy that allows you to survive stage 6 and be ready when the system stabilizes. The pattern is already forming, and you can act. You have seen it. The $50 billion exits, the silent rotations, the information gap, the controlled sell-offs, the first cracks of collapse in 2025. History repeats with mechanical precision. The same pattern destroyed Spain, toppled Britain, shattered 1929, Wall Street, and left millions exposed in 2008. Now, the pattern is forming again, right in front of you. You have a choice. Ignore it and hope the markets remain stable. Pretend the debt, leverage, and institutional exits don't exist. Stay passive while the system executes the same deadly blueprint once more. Or recognize it. Understand it. Prepare. You have 3 moves: liquidity, hard assets, diversification. That's it. 3 moves that could determine whether you survive the next stage or get trapped holding the collapse. The system lets the powerful sell first. It always has. It always will. But knowledge is power. Strategy is survival. If this video showed you a pattern you've never seen before, subscribe. Because the next part of the pattern is already forming. And when it unfolds, you'll want to be prepared. The choice is yours. History is not waiting, and neither should you.